Did you know that if you had invested $10,000 in Amazon back in 1997, it would be worth over $25 million today? And what about Coca-Cola? That same $10,000 investment in 1980 would have grown to over $1.3 million with reinvested dividends. Both examples are overwhelming, and investing in either of these companies over such a long period of time would have resulted in huge capital gains in each case. But the difference is still quite noticeable, as the first example would have generated a larger return in a shorter period of time than the second one. These stunning numbers highlight two different investing philosophies: growth investing, which looks for disruptors and innovators, and value investing, which focuses on steady performers trading below their value. Growth investing is about riding the wave of innovation, betting on companies like Tesla that aim to revolutionize industries. Value investing, on the other hand, is about finding hidden treasures, companies like Coca-Cola that quietly dominate their markets and generate consistent returns. Each path offers its own advantages and disadvantages. But which strategy is right for you? How do you decide whether to chase rapid gains or choose steady returns? Let's break it down. The origins of value investing can be traced back to the aftermath of the Great Depression, a time when trust in the stock market was at an all-time low. In 1934, Benjamin Graham, often called the father of value investing, co-authored Security Analysis with David Dodd. This groundbreaking book introduced the concept of intrinsic value and emphasized the importance of buying stocks at a margin of safety. Graham's methods were revolutionary. He taught that investing wasn't about speculation, but about owning a piece of a business. His teachings laid the foundation for modern value investing, inspiring a generation of investors, including Warren Buffett, who studied under him at Columbia University. Value investing is the art of finding diamonds in the rough. It's about identifying stocks that are undervalued by the market, essentially buying something worth $1 for 80 cents. Value investors rely on hard data and fundamentals. They analyze balance sheets, income and cash flow statements, and economic trends to determine whether a stock is truly undervalued. The strategy involves picking stocks whose market price is less than their intrinsic or book value. Value stocks are characterized by having low price to earnings and price to book ratios, showing that the market undervalues shares compared to companies' earnings and real book value. Also, the fact of consistent and growing dividends can serve as an indicator of financial stability of the business. Moreover, it is good when the stock price does not match the market's expectations regarding the company's projected profit growth. This undervaluation creates a good opportunity for a value investor. Legendary investors like Warren Buffett have built fortunes using this strategy. Buffett's mantra states that price is what you pay, value is what you get. Value investing has stood the test of time, offering reliability and stability in volatile markets. Examples of such stocks are Johnson & Johnson, Coca-Cola, Procter & Gamble, ExxonMobil, McDonald's, Walmart, and many others. Investments in such companies provide safe and constant capital growth and eliminate high volatility of the investment portfolio, especially during periods of market downturns. Growth investors are less concerned about today's profits and more focused on tomorrow's possibilities. They look for companies with massive market opportunities and strong revenue growth. Nowadays, most of these examples have emerged in the technology sector, as these companies sell innovative products and services. Their rapid growth and overvaluation are largely because companies hype around emerging trends and also due to optimistic projections regarding their revenue and market share. The recent case of NVIDIA is a good example of how hype around a trend can accelerate the growth of stock prices. Just imagine that if you had invested only $100 in NVIDIA stocks in 1999, your net worth would grow to an incredible $337,000. Over the same time period, investing $100 in the S&P 500 would only earn you $474. This example clearly shows the potential of growth stocks relative to the overall market. Knowing characteristics of each strategy, you could probably distinguish potentially value and growth stocks using companies A and B as an example. Of course, company A represents the type of stock that value investors prefer: stable, profitable, and trading at a reasonable price. Meanwhile, company B's characteristics are typical of growth stocks: You're probably wondering why we should consider both strategies if we can just figure out which one is more profitable and use only that one. That would be a good idea, but unfortunately, it is not that simple because the returns on these types of investments can vary due to some factors. Let's first discuss the macroeconomic factors that determine which strategy will be more profitable at a given time. For example, a low interest rate environment means low borrowing costs, which encourages growth companies to borrow and invest in research, expansion, and innovation. As a result, these firms can develop a competitive product and quickly increase their market share. This leads to higher earnings, attracting investor attention to the company's stock and increasing its value. On the contrary, during periods of high interest rates, growth stocks become less attractive, facing financial problems due to their focus on future earnings. Value stocks, on the other hand, show their reliability and stability by focusing on current profitability and dividends. Another factor to consider when choosing a strategy is determining the current economic cycle. Growth stocks thrive in bull markets, when optimism is high, and investors are willing to take on more risk in anticipation of much higher returns. During these periods, investors pay a premium for companies that offer innovation or even just sell the idea of creating such a product. However, in bear or recessionary markets, value stocks often outperform. Their stable earnings and dividends act as a hedge against market volatility. Think of companies like utilities or consumer staples. People still buy toothpaste and electricity, even in tough times. Apart from macroeconomic factors, investors should be aware that different sectors are aligned naturally with each investing style. Growth stocks dominate emerging fields like technology, biotechnology, and renewable energy. Companies like NVIDIA in AI or Moderna in biotech are prime examples of high growth potential fueled by groundbreaking innovation. On the other hand, value stocks are often found in mature sectors like consumer staples, industrials, and finance. These industries might not double overnight, but their established market presence ensures consistent returns. It is also worth noting that market psychology and sentiment play a significant role. Growth stocks often attract speculative interest, leading to price surges driven by hype rather than fundamentals. This can lead to bubbles, as seen in the dot-com era. Value stocks, with their focus on fundamentals, tend to be less influenced by speculation, but they're not immune. Overly pessimistic markets can push even solid companies below their true worth, creating buying opportunities for savvy investors. Now let's see direct comparison of value and growth stocks over different periods of time. This graph demonstrates the ratio of value to growth stocks returns. Let's identify some of the factors that made growth investing more or less profitable than value investing at different times. For example, from the early 1990s to 2000, growth stocks outperformed due to the hype around internet companies. After the tech bubble, investors began to pay more attention to value stocks, as they are seen as less volatile and more stable during periods of uncertainty. Then, towards the end of the global financial crisis and up until the present, growth stocks have come to dominate value stocks greatly. One of the main reasons for this is the low interest rate environment. From 2009 until 2016, the interest rate in the US was almost 0%, which has encouraged the rapid expansion of smaller companies and startups. So, which strategy is better? The truth is that it depends on your goals, time horizon, your risk tolerance, and many other factors. Value investing offers stability and income, while growth investing promises high returns for those willing to take the risk. By blending these strategies, you can enjoy the best of both worlds: steady returns from value stocks and exponential growth from innovators. Remember that a well-assembled and diversified portfolio could provide higher returns and lower risks at the same time. If you enjoyed this video, please like and subscribe to support our channel. Also, let us know in the comments which strategy you would choose. See you in the next video.